Hello everyone, and welcome to Pocket CFO. I am your Pocket Chief Financial Officer. Today, we are tackling a topic that every cross-border business owner, CFO, and international trade professional cannot avoid right now: the surging Chinese Yuan. Why is the RMB rising so fast? Is this just short-term market emotion or a long-term trend? And most importantly, is this an opportunity or a trap? If you are a boss managing cross-border trade or global expansion, today's video is highly actionable. I highly recommend watching until the end. Let's get the facts straight first. Since the second half of 2025, the RMB has been on a strong rally against the US dollar. It broke through the 7 mark from over 7.3 and by early 2026 hit around 6.83 to 6.84. That is roughly a 3-year high. In plain business terms, if you previously repatriated $1 million, you would get about 7.3 million RMB. Now, you might only get a little over 6.8 million. That difference of several 100,000 RMB is a direct hit to your actual profit margin. This is exactly why everyone is so anxious. Why is the RMB suddenly so strong? This surge isn't caused by a single factor. It's the collision of 3 major forces. Force number 1. It's not just a strong RMB, it's a struggling US dollar. The starting point is actually in the US. Following the 2025 administration change, we saw heavy tariffs, expanding fiscal deficits, and constant pressure on the Federal Reserve. Global investors lost confidence. Capital started selling America, leading to one of the worst USD index performances in decades. Force number 2. Unprecedented exports and the dollar influx. In 2025, China's trade surplus hit a historic high of $1.2 trillion. Exporters are sitting on a massive pile of dollars. Once the market expects appreciation, companies rush to convert their offshore holdings. It creates a feedback loop. The rates rises, companies fear losing money, so they convert faster, pushing the rates even higher. Force number 3. Global capital is looking back at Chinese assets. International funds are looking for stability amidst global uncertainty. Foreign capital is returning to Chinese stocks and bonds. When more people globally buy RMB assets, the currency hardens. What about the central bank? They are acting as a stabilizer. They tolerate growth but hate volatility. Now, for the part you care about most, how does this affect you? Let's look at outbound Chinese enterprises. First, the direct hit to the income statement. If you export and collect dollars, exchange losses are eating your profits right now. We've seen firms go from billions in gains to billions in losses. For many trade bosses, a currency swing simply wipes out the margin. Export competitiveness is changing. Low-end goods suffer, but companies with real tech moats are more afraid of tariffs than currency. The silver lining: overseas M&A is cheaper. If you are taking RMB overseas to buy factories, your money now goes much further. For our international viewers and foreign enterprises, the rising RMB presents a dual-edged sword. Financial investors get a boost. A rising RMB means your assets automatically gained value when converted back to dollars. However, operational costs are rising. If you source in China, these costs are in RMB. China just became more expensive for physical FDI. Finally, here is your financial and tax action checklist. Audit your exposure and map your foreign currency income first. Establish routine hedging. Use forward contracts or options. The goal is risk neutrality, not currency speculation. Hedge in tranches. Push for RMB settlement. Start quoting in RMB for long-term clients, or build exchange rate clauses into your contracts. Leverage the strong RMB. If you have a 3 to 5 year global strategy, now is the time to negotiate overseas mergers and acquisitions. The RMB surge is neither luck nor a disaster. It's about preparation. Subscribe for more on pricing strategies and tax traps. I'll see you in the next video.